Hi guys, good afternoon and welcome to the CNBC-TV18 Mumbai newsroom. I'm Pavitra Parekh. With me is Sonal Bhutra. You guys are tuned into Mutual Fund Corner. And today we're going to talk all about passive investing. Now, this is a strategy that really focuses on tracking the performance of a specific market index rather than actively trying to outperform it. So what are the benefits of this style of investing? What are the options available if you do want to invest passively? We'll address all of this over the next half hour. So we have lots cut out for us.
We do actually, lots to talk about, right? So let's welcome our guests for the show today, Raghav Iyengar, who's the Chief Business Officer at Axis AMC, and Ashwin Patni, who's the Head of Products and Alternatives at Axis AMC. Gentlemen, good afternoon. Thank you so much for joining us today here on CNBC TV18 to discuss all about passive investing. And Raghav, that is my first question, because we have been talking about a lot of headwinds. We are talking about maybe the market won't do much this year itself. So what do you see as the case for passive investing, particularly right now, when we are not expecting markets to do much this year?
I think passives is a very, very important part of an investor's portfolio. I think there's an old saying, Sonal, that investments is all about asset allocation, right? I think typically 90% of your returns come from the right asset allocation. The remaining 7, 8, 10% comes from actually what you really buy. So its passives was earlier seen to be an or investment. I mean, either you have investments in a normal mutual fund, or you put money into an index fund or a passive ETF. I think in my view, it is more of an and. It has to be an important part of an investor portfolio. I think the good thing about passives is it takes away the emotion in terms of what stocks to buy, what not to buy, because you're essentially tracking an index. And hence, I think in a year where there is so much uncertainty, one doesn't know what is going to do well, so much talk about recession, global, and I'm sure there's enough of clouds in the air, in the TV, everywhere else. I think passives is a very, very simple way to sort of start investing. So for someone who ask me, I think the easiest thing to do is to start, if one is confused as to what to do, I think pick a good index fund, maybe a Nifty 50 or a BSE Sensex, and just start investing a little bit of money very regularly. I think it's a good place to start your investment journey.
Yeah, and I guess, when you talk about passive funds, people sometimes get a little distracted because they take a look at the 1-year return on the market and then they get a little bit, worried about it. But you definitely do or should get in with a longer term approach. Before I, move on and talk more about the ways of investing and the options available, yesterday the Sebi wrote to the AMFI and they've allowed mutual funds having already managed open-ended ELSS schemes to launch passively managed schemes as well. Now, this can of course be done only after stopping your fresh inflows and subscriptions into existing actively opened ELSS schemes. So what is your take on this, Raghav? Do you, how much of a benefit do you see on this?
I think for established schemes like, let's say, the Axis Long-Term Equity Fund, which, by the way, we sell as a long-term investment, apart from the tax benefit that you get. And many of our investors, it's one of our largest retail schemes. In fact, it is the largest tax saving scheme in the market. Most of our investors have crossed that 3-year threshold, Pavitra. So for us, actually, it's going to be, it's early days. We haven't really figured out what that circular is about. But for someone who is not wanting to launch an open-ended fund with all the issues around it, I think there's an easy way to start an ELSS fund there. So I'm not sure how Bots is going to achieve immediately, but I think old established funds with a good track record, I think will continue to take money in their existing funds. But maybe for someone who's just started, doesn't have a track record, possibly a passive ELSS may make sense.
Okay, all right. So let me come across to you, Ashwin, now, and let's take this idea of passive investing forward, because we have a lot of options, be it equity, be it debt. Does it make sense to invest in both the categories, or it should ideally be focusing on one of them? What is your take?
So I would say that basically it is, Raghav mentioned this in his earlier response, that essentially it's about, it's just a simple vehicle to access things for investors, very easy to understand, very simple to execute. And therefore it dwells itself well for all asset classes, equity, fixed income, commodities. We have global asset classes as well in the market today. So I would say that it's not that it's better for one versus the other. Of course, if we go back a few years, there were much more viable options within the equity space than there were in other asset classes. But I think last 2-3 years, we've seen a really good positive development where a lot of fixed income options are now open, passive options are now opening, or have opened up for investors. So today we are in a very, very sweet spot for the passive industry, for investors in general, that the choice has really broadened. There is something for everyone. We look at commodities. There is now, beyond gold, we now have silver, we have global. So I would say it's not right or wrong for any one asset class. Investors have now a power of choice. They should look back at what they are trying to achieve in their portfolio. For most investors, allocation to equity and debt makes sense. The mix, of course, they can decide. And therefore, I would say that both of these at least would be something that I would recommend for them to look at, both equity and fixed income.
All right, got it. Ashwin, one more question. Do you think everybody should own some amount of passively managed funds? Is it different for different people? And do you think there's a specific type of investor that this is better suited to? I know Raghav briefly touched upon this, but if you could take us through this as well.
Yeah, so I think we avoid giving one size fit all, suggestions, or because it's a very personal thing, investing, and the most important thing is that people should be comfortable with their journey, because it's a journey that, if it has to have any chance of success, it's a journey that they have to stay for the 5 years, 10 years, very, very long periods of time. So what they should avoid doing is things that, are being done because they are the fad, or that is what everyone is talking about today. And we've all seen in the markets how scenario changes, or how the talk changes in 3 months and 6 months, and suddenly the whole scenario looks very different. So we have to be careful that we have thought through and understood what we are getting into. I think Raghav was making the point that it's easier to understand what passives are for first-time investors. Having said that, it's not that passives don't require homework, right? You need to understand the index. What is it when you're saying that, for example, we're talking about investing in, say, a Nifty 50, then what does that mean? And what will it do and what will it not do for your portfolio is something that you do need to understand. So to go back to my original point, it's not easy to give a one-size-fit-all perspective on this. I think both passive and active can make sense for investors given whatever context they have. You could probably make an argument that for most investors, once they decide the asset allocation, both passive and active can work. Having said that, individually, people will need to understand what is it that they are comfortable with, their own personality, their own, perception of these two and understanding of these two, so that they can stay with them long term. Because what will work for them is if they stay with the long term. If they are going to jump in today because everyone's talking of passive, and 6 months later say no, I actually wanted alpha, or I wanted a particular style, and move that's probably the thing that people need to really avoid.
Oh yes, your own risk profile and the way you want to invest, short term, long term, is something that you need to take care of before looking at any of these funds. Raghav, let me come to you, and this question is actually to the two of you. Let me start with you, Raghav, first. Index funds or ETFs are often recommended to new investors who may not be too educated in the space. So do you think this is a good way to start your investment journey, or anyone who is new to the stock market should start it the simpler way?
Fundamental principle of investing, Sonal, is you invest in something that you understand. Right? I think, and unfortunately or fortunately, capital markets are complicated. So in that sense, an index fund or an ETF is a much more simpler vehicle to understand, especially if you look at some of the frontline indexes like the Sensex or the Nifty. They've been around for a very, very long period of time. The stocks are pretty much the top large cap stocks. Everyone knows them. But again, like Ashwin mentioned, I think it's an individual choice. I mean, I'm a recent passive investor. To give my example, I've always believed in an active philosophy, given that most of my money is invested in India. And I think India is an emerging market, but now I have come to a bit of a realization that at least I need passive debt funds, if not equity funds, in my portfolio. So I guess it's not a one size fits all, but I think it's an easier it's an easier index, it's an easier option to understand. But the key is is to get going. I think that's important. I think most people spend too much time, sort of researching and really don't get into action mode. And I think shows like what you're doing now, hopefully will get some people to get out of research and get into action, thanks to some of the advice that you're doing.
This is what we talk about so often, right? That because you don't understand it too much or you're hesitant, you just sit on the sidelines and, you waste so much time in the process. But Ashwin, let me toss the same question to you as well. Do you think that index funds are perhaps a good starting point for an investor who may not be too educated in the market, and this is just a good way to at least get in?
I agree, because you have to see that what is the index fund doing for that for a normal investor is that it is giving that person access to what they believe is the market. And every day when they open up, they watch TV, they open the media, whatever, what gets reported is, the headline indexes, whether it's the Nifty, Sensex, etc. So if there's a product which just gives them a chance to just participate in that story, that is something that intuitively is very, very easy to understand what is happening in that sense. Whereas the minute you come into active management, you do need to have a much better grasp of what the philosophy is like, what the fund manager is trying to do, etc., which typically will come over a period of time from an understanding perspective. So yes, it's probably easier for someone who's starting off to relate to a simple index because of the sheer exposure that is available to indexes in our everyday lives, right? We all talk about what Sensex has done today or Nifty has done today or tomorrow and all that. So if you just link it to that and invest around that, just makes it much easier intuitively for someone to appreciate what's going on.
Of course, and that's the reason we have this dedicated show, right? So we can talk about things beneath the actual index as well. So we'll keep getting your advice on this. But for now, gentlemen, hold on. We'll slip into a short break. But before that, here's an important information for our viewers. Don't miss out on the 19 must-have stocks for 2023. Subscribe to Money Control Pro to get the full list. Welcome back. You're still tuned into Mutual Fund Corner on CNBC-TV18. We're discussing all about passive investing, and we still have with us Raghav Iyengar and Ashwin Patni of Axis AMC. Raghav, let me come to you. We've discussed how passive investing works, who can actually invest in such kind of funds as well. What do you think could be the drawback of this method of investing? Somebody who should stay away for, say, XYZ reasons for at least this asset investing.
So I guess I don't think there's any serious drawbacks, Sonal. I think it's probably a great way to invest. I think just like Ashwin mentioned in the initial part of the show, their passives have a lot of complexity. Some indexes are very, very simple to understand. Some are reasonably complicated. They need a fair amount of research themselves before you get into it. Some are very, very narrow. Some don't have very good liquidity. So I guess don't invest if something is in a fad. Please understand what you're getting into before you jump into it, and not just because somebody told you, whispered in your ear that that's a great return. Number two is please don't go by immediate past track record. I think some indexes tend to do very well in very short bursts of time. And those are the ones, unfortunately, that get picked up because of their recent performance, right? And I think it's very, very difficult for any investor, forget a layman investor, to understand what's going to work. So if you don't understand what you're investing in, please don't get into it. Please don't look at recent trends, and just don't get into fads and stuff just because it sounds very good. I mean, the whole case of crypto is an example that we all are aware of.
Okay, that is on passive investing, and perhaps, all kinds of investing. You have to understand the method that you're using and the strategy before you do sort of commit to it. But Ashwin, coming to you now, several people prefer actively managed schemes for the simple reason that they believe that these funds will have higher potential to do better. And this is not based on nothing, right? In India, historically, actively managed funds have done way better. Your thoughts on this? And do you think even in this market, it's still better to have some kind of exposure?
So, Active funds, as you rightly said, have delivered, alpha for investors in India. I think that's the data that is there long term. But also the problem that happens, and we do this analysis every year where we compare fund returns and investor returns. The problem is that a lot of investors tend to not stick around for the full cycle, and they get swayed by shorter term periods. That could happen for two reasons. One is because the market itself is volatile, or the other one could be that the fund manager sort of style is going through some cycles which could go through ups and downs. And we all know that there is no simple straight line outcome when it comes to equity investing. All options that are there have their ups and downs, have their cycles, which need to be kept in mind. So invariably, what we see happening with many investors is that you do take the ride when the going is good, and when the when the cycle turns, then you get a little fidgety and start second guessing whether it was the right decision or not. What would help, I think, investors is to take a balanced perspective on this, take a longer term perspective on this. So it's not an either or equation. Both active and passive can fit in well and work well for most portfolios. Think through the holding period, think through the cycle, and take a call that you feel comfortable for the long term. And if people are willing to hold for the long term, as you rightly said, and I said just now, we've seen that alpha is very much there for investors who stay on for the long term. But yeah, it needs to be done with that amount of sort of preparation or thought process beforehand, so that you're not trying to second guess yourself when, market will invariably test you when it goes through ups and downs.
Oh, of course, due diligence is of utmost importance, right? Raghav, the next question is to you, because, Pavitra looked at some interesting data earlier on how large cap funds fared in 2022, and most of them actually failed to even beat the benchmark. Do you think in this case, passive investing works especially well for this category that we've been discussing for so long now?
As in large cap, Sonal, you're talking about large caps?
Yes.
I don't know. I think one year data is too short a period. I think it's, to my mind, I think large caps tend to do very well over longer periods of time. So I think if you look at the 5-year, 10-year data, it's actually the reverse.
Raghav, she actually looked at 5 years. She looked at a longer period of time as well, and the results were largely the same.
I think that's what I said, Sonal. I think it's a bit of at points of time, certain parts of the index tend to do well compared to maybe styles not doing well, right? I think in the last couple of years, for example, quality has not done very well, and whichever fund managers have a quality bias have actually underperformed the index. But these are cycles. I think it's very difficult to call it from here on that what will perform or not perform. So I think the important thing is to have a mix of style, a mix of capitalization in your portfolio, so that at some point of time, some parts of your portfolio are doing well, and you be fully conscious that, it's very difficult to get 100 on 100 like it is in real life. I think the same thing will happen to your equity investment portfolio too. So yes, I think that's where I think passives do play a role. I started off this session by saying that it's not an or. You have to have money both in active and in passive funds, and obviously within passive funds, obviously some allocation to the Nifty or the Sensex in the large cap space is useful.
Okay, got it. Now let's talk about what within the passives, right? Ashwin, there are 3 main ways that you can invest passively. You have index funds, ETFs, and of course fund of funds as well. How do you decide which one you should go for amongst these 3?
ETFs are a very specialized, vehicle, because they have a peculiarity that they are not bought and sold like normal mutual funds. They effectively trade more like stocks, where you have to have a demat account and trade them during live market basis their NAV and all that. So for a normal mutual fund investor who's looking at, SIPs or regular investing and just sort of a simple a way to just add on to their mutual fund experience, index funds work quite well, because, you can do the switches, you can do the redemptions, you can do the SIPs, STPs, etc., just like you would in any other mutual fund scheme. ETFs, on the other hand, can work really well for people who are looking at, intraday options, the ability to invest. So, for example, we typically do have large intraday movements on some days, which are big events in the market. You're trying to sort of take advantage of those, or you want to be able to trade in and out of your positions and things like that. So that's where ETFs can be quite handy because they trade like stocks, and you can do pretty small ticket trades as well within ETFs. Fund of funds, I would say right now is still more of an emerging alternative. There are a few products out there, including we have some things as well, but it's still something that people are trying to sort of get their head around in terms of how that whole thing will work. So it's a little more nascent. My suggestion would be, that typically the big two, of course, routes are index and ETFs. And within that, for a normal mutual fund investor, probably index fund is the one that is very easy to sort of understand or get their head around because they work exactly the same way like regular mutual funds.
All right, Ashwin and Raghav, thank you so much for joining us today. That definitely was a masterclass in passive investing. Do your due diligence and then go about investing. Thank you for explaining all of that to us. So with that, we've completely run out of time on this edition of Mutual Fund Corner today. Stay tuned for Closing Bell. It'll take you through the last hour of trade.